how would you shape up the portfolio strategy together? I do recollect that when we spoke the last time, we extended on the whole aspect of saying that we look at equities in 3 baskets, we look at compounders, we look at sector rotation strategies, we look at cyclicals. If in the previous month, in the previous edition when we spoke about a bulk of it being in sector rotation and evenly balanced between the two tails of compounders and cyclicals. How has that evolved in this, say, 4 weeks?
Yeah. So I think, I think what one is seeing from, corporate commentary and the numbers and business updates, one is seeing, growth in various pockets. So they're not really adjacent. You're not seeing a situation where certain traditional large sectors
clearly IT not doing well,
are not
as
going,
well.
Are not going places. I mean, okay, they're chugging along,
but not
except for IT, which is having a different issue altogether. But the traditional large sectors,
if I were to look at the index, the large sectors aren't doing too well.
Are kind of in a little bit of a soul searching, if I put it that way. So therefore, that's what is happening over there. But you're seeing a lot of these smaller sectors, which could be things like the whole power ecosystem, which is not the utilities, but the utilities also doing well. But beneath that, the entire power
renewables,
ecosystem,
the wires,
the energy
cables,
transition, wires, cables, and transformers, and all of those. Or you look at the whole semiconductor, electronics, now the nuclear part, the entire ecosystem around data centers. So all of these small areas, which are all deep cyclicals in a way, you are saying at least one is hearing so much of investment going in all of these spaces. It could be precision manufacturing, those areas as well. So I think that's really where the action is shifting. And earnings growth over there seems to be substantially higher than what you're seeing in the traditional sectors. So I think from a portfolio standpoint, I think we are trying to kind of acknowledge this and therefore see how we can kind of play this. Now, this is on one side. On the other, what you are seeing is, while generally one looks at Nifty valuations and says that, Nifty valuations are largely in line with long-term averages.
About 20 times?
About 19
forward,
times or thereabouts, yeah.
Forward,
And I say, my last 7-8 years, we have been around this number, so we kind of okay. But the point is, if you strip out some of the beaten down sectors,
say ex-IT,
banks or IT or one large conglomerate over there, if you strip out some of these, the rest of the market, then the valuations seem actually, if you look at those numbers stripped of these, the valuations are actually higher. So therefore, this is a market which is saying that it's willing to pay a little higher, but for growth. And therefore, it is very important that growth actually comes through. The execution related point therefore becomes that much more important. And this market is very, very punishing, as we have seen.
Is that, I was just coming there, you've been seeing in the last 15 days, responses to earnings are extremely brutal. Not so much on the upside, but if the results are just in line, I think stocks are getting beaten out of shape. So
yeah, exactly. So I think that's really what it is. So the way we are trying to play it in a way is, of course, within those 3 buckets, but acknowledging the fact that the earnings growth is really coming a lot more in the SMIDs. So that much,
from a market cap perspective.
From a market cap perspective, kind of tilting it, but being acutely aware about the valuation related considerations over there. Therefore, looking at those pockets where, and we're also seeing that, right? I mean, if you look at strategies, pool strategies, funds, managers, what they're doing, we're seeing a couple of things that are coming through. One is essentially people are taking a lot more active weight now. They're clearly saying that smaller sectors which are not there in the benchmark, they are demanding far more attention. So therefore there is active weight that we are seeing is drifting higher. A. B is, I think people are very conscious about valuations, and therefore the way they are probably trying to kind of manage that at a portfolio level is to see that where the visibility in growth is higher, people are willing to pay that and probably take some bit of exposure there, but balance it out with pockets where the valuation comfort is reasonably good, even if it means that probably the growth is not going to be in those 30-40% kind of numbers.
So you're saying within a portfolio, people are playing across segments, a little more moderately valued, steady, and a little what shoot for the stars kind of pocket.
Yeah.
But in addition, I just wanted to make a point here. We are also probably seeing longer tails on portfolios.
Yes.
We are seeing a little more of churn. People are actively wanting to go take money off the table and keep it. This is something I've not heard fund managers do. I mean, they normally are the buy and hold language. That seems to have turned in this cycle for clearly.
Yes.